Hopefully you can see my screen. My name is J.D. Geneser. I'm a senior partner with LWBJ. I know you're used to Mike Caldwell teeing these up and kind of being the moderator. I have unfortunate news that Mike had a family member pass away. So Mike is not able to participate today. And so I've used his login, and you'll see my picture above Mike Caldwell's name. But again, I'm J.D. Geneser. LWBJ is a CPA, consulting, investment banking firm. I work with a lot of startups on raising capital. We do a lot of M&A as well. I'm also a partner in an investment fund called Mango Seed. So see a lot of different perspectives of raising capital, and then obviously just work with a lot of capitalization tables. We're going to walk you through and we're going to keep it at somewhat of a high level. Capitalization tables can become very, very complex, and each one's a little unique to each situation. We're going to walk through some scenarios, just it's really more of an introductory process, but just to show you some what ifs and what happens through kind of the evolution of a company. So that being said, I also have asked Lana Fox, Tej Dawan, and Sheldon Oringer to kind of assist me in this process to bring some perspectives. They're executives, entrepreneurs, and investors as well, and appreciate their time kind of filling the gap of making sure that I don't gloss over things too fast, and also bringing some real world perspective to some of the things we're going to cover today. We wanted interactive. I think I will be able to open up the chat room now if it's not already opened. And obviously we want you to ask as many questions as you can. So. All right. It looks like we've got most everybody logged on, so we'll begin the process here. So this is my bio. You can read it. I don't need to necessarily cover it again. This is the Raising Capital Seminar is an endeavor of Greater Des Moines Partnership. LWBJ is very proud to be associated with it, and then Brown Atlantic Law Firm is just a great law firm, great securities firm we do a lot with, and I believe the next session is going to be led by Joe Leo on covering term sheets. Again, just thanks for joining us. If you can, mute your microphones, turn your video on if you'd like. I believe the chat window is open, and if not, you'll have to, maybe Tej will have to instruct me how to do that, but I think I've got it open, and we will be recording this as well today. This is the fourth module. The cap table, who owns your company? There's been 3 prior modules, and next Wednesday is the term sheet. We will cover, up to the term sheet on a lot of matters today, with regard to what investors' rights are as it relates to the cap table and ownership and liquidation. But I encourage you to kind of get a deeper dive on the actual term sheet next week. So what's a cap table? It's in the simplest terms, it's a list of your company's security stocks. It tells you who owns what. I'm going to stress multiple times, you always want to keep it current. There's really no right or wrong way to format your cap table. You'll see the way I do it, but there's really no right or wrong way to do it. You want to keep it simple, and then you always want to have your corporate documents. You should have corporate documentation for every line item on your cap table, and if you can tailor your cap table to those supportive documents, it's just much easier for you, for your investors, and for even potential future investors. And finally, it's a great planning tool for future capital raises. It allows you to do a lot of what-if scenarios. Again, keep it updated at all times. Investors will want it in any diligence process. They're also going to want it in all the underlying supporting documentation. We work with a lot of companies, which, on what we call a pro forma cap table. You can run multiple scenarios of taking a look at pre-money valuation, new financing or future rounds of financing. You can analyze the dilution impact, and even the impact on an option pool or granting a specific amount of options to a new hire. Some common terms that you'll see associated with the cap table. Some of these have already been discussed maybe in some prior sessions, and some will obviously be discussed in the next session with the term sheet. But it's just the vernacular of unit of measurement. A corporation has shares and an LLC has units. Nothing fancy about it, just the demarcation of the difference. Rounds, you'll hear of rounds and series. It's just basically defines a specific financing event. You can have founders rounds, you can have friends and family rounds, seed rounds, and then you get into the series. I work with a client right now that's had multiple series. They're on their Series E, actually. But it's just a definition of a specific financing event. And there is some definition, and I think, Tej and Sheldon, you might be able to add a little perspective, but what used to be a Series A seems to be a seed these days, and the definition keeps changing. And so it's kind of interesting, because I think Series A is really defined more of that institutional play. But it's really, each entity describes it a little bit different. And I think each region even identifies a seed round versus a Series A round a little differently.
Yeah, JD, I'd say the seed round seed round has definitely moved left, and the friendly angels, if you would, are becoming friends and family in the vernacular. Many times the angel investors are investing at friends and family valuations, friends and family terms, things like that. So you're absolutely right. Definitely moving left.
We've had situations where I have a current client that had a Series A, and then they were going to go to market, and the Series A was primarily high net worth individuals and, if you will, angels. They actually repapered the process to call it basically an additional seed round. So when they went to get to the Series A round, it was, I guess, viewed more something they could present institutionally, but they hadn't already had a Series A. So again, it's just maybe a little bit of the timing and a little bit of geography as well, how things are perceived. So also on a cap table, and then just even raising funds, you have a couple of terms on valuation. And pre-money is just what you put the value at, basically enterprise level value of the company prior to the financing round. And obviously, if you're going to raise a financing round, post-money is the valuation after that financing round. So in just simple terms, if somebody puts a pre-money valuation of their business at a $4 million and they raise $1 million, the post-money is going to be $5 million on that. So that $1 million investment basically represents a 20% equity ownership, because it's $1 million now out of that $5 million valuation. So again, it's just terms you'll hear a lot of pre-money and post-money. And we'll talk a little bit more. That pre-money, I've done actually specific presentations on valuation of early stage companies. Actually did one for the Angel Capital Association when they had their event here. I was on the panel of that, and while we do a lot of valuation work, for mature businesses, and you look at the income that puts off, the cash flows, et cetera, the early stage businesses, it's a lot more art than science setting that pre-money. And generally, it's whoever will kind of invest under those certain terms and set those terms is really how you set the pre-money. At earlier stage, it's usually friends and family, et cetera. It's one of those things where it's more of a trusting type of situation with family. You get them to buy in, et cetera. But as you go further into that process, it's really more of a defined process. But it's a subjective, very subjective term, and very much negotiated.
JD and Sheldon, I just add, after that friends and family round, as JD just said, you may want a $2 million pre-money valuation, but it's really your investors that are going to tell you. I mean, you get to accept it or reject it, but really it's the investors that would say, hey, I'm in at X, I'm in at 1.5 million, or whatever it is. I mean, everybody should get the same deal, but sometimes you go out wanting maybe something higher than you ultimately receive. That is not untypical. And again, the terms are typically set by the investors, even though as a seller of securities, you obviously typically want the highest amount that you can get at any stage that we're talking about.
Yeah, great point. So some other common terms, you know, the term recapitalization or down round is really, it's a situation. We're actually going to walk through one, but it's where you've raised funds in the past at a certain valuation, and then you go back to the market or to current investors and reduce basically the value of the business to either one, you know, keep the business alive or basically refinance the business, et cetera. And we will walk through a scenario of that, but it's just a common term, down round. And a lot of the challenges and a lot of the reasoning from a down round is because the pre-money valuation on the earlier rounds might have gotten a little ahead of the business itself. Options and warrants, basically, they're just basically incentives, the right to purchase either units or shares in a company at a predetermined price, what we call strike price. And really what it is it really allows someone to share in the upside as the business creates further value. Those options are basically valued today, let's say, and then they have the option to exercise those and buy at today's value in the future. A lot of times it's upon a liquidation event or something like that that it occurs, but it is a right to buy stock, and it is usually those options are shown on a cap table as a fully dilutive basis, just simply because they could become owners in the business down the road. Preferred and common, basically common shares are just that. I mean, they're usually founder shares, maybe friends and family shares. We're not going to get into, and I think I'll trust Joe next week to get into some more specifics on some of that. But basically, preferred means just preferences and rights. And generally, you see preferred shares the more you move towards the institutional route and the Series A rounds, B rounds, C rounds. It's just giving investors liquidation rights, governance rights, etc. So again, very common terms. We'll just kind of keep it at a high level there. Liquidation preferences, again, I just mentioned. At a very high level, that just means they have the right to get their funds back at some formula ahead of other shareholders. And we will walk through an example of what a liquidation preference is and kind of the impact of that. And then you may have heard terms waterfall analysis. All that is looking at basically who owns what, a cap table, and saying upon a liquidation event, what shareholders get what from the liquidation proceeds. Types of investors, accredited, and basically that's generally an individual that meets a certain income test. It can be an entity as well. They basically, for lack of a better, they pass a net worth test. And what that really means in accredited investors, one, they're generally more understanding and more sophisticated, but secondarily, there's less risk associated with them because they can afford to lose the funds. And so there's a certain security classification and exemptions associated with if you just raise money from accredited investors. Friends and family are not always accredited investors. They're just that. It's early stage friends and family. Most of the time they're not accredited. It's that initial round after the founders round that believes in the company, believes in the mission, obviously has a relationship with the founders, and really is more of a, hey, yeah, we're betting on you. Angel is just another term, and it's generally a definition of a high net worth individual. Seed funds are really just early stage investors, but they're more institutionally focused. Sometimes seed funds have outside investors as well, and they really target early stage opportunities of companies. Family offices, we've seen a lot of growth in this area, and generally it's a high net worth family that actually retains investment professionals to do alternative investing on their behalf. And we've seen even in this region a great deal of family offices pop up, meaning that the families are diversifying a little bit, getting into private opportunities, and generally they do have, if not someone full-time, they have an advisor that helps them vet deals. Strategic investors are really that. It's an industry type investors that bring maybe more than just financing to the table. They could bring distribution, they could bring customers, they could ultimately bring exit strategies to the company as well. But you'll hear that term a lot as well. It's a strategic investor. And then institutional, And venture capital is just that. It's the more sophisticated venture capital funds that have outside what we call limited partners. They generally drive, more harder terms, valuation terms, preferences, et cetera. Yeah, we just glossed over those, but those are a lot of terms you hear in the financing process, and then obviously the cap table process. So I don't know if anybody has any questions as we went through those terms. We went through them pretty quick. I think what I'll do here is just kind of give you a recap of what we're going to do today. We're going to, again, keep this at a very high level. We're going to present 5 rounds of financing for a fictitious company, show each round's impact on ownership percentages. After the 5 rounds, we're going to present 3 different exit scenarios and kind of the impact of capital return to investors and the founders. So we have 3 founders of SaaS Systems, Amy, Bill, and Chris. And what they've done is each contributed a little bit of capital and intellectual property. Each brought something different to the table. And they agreed on the formation of the company that they'd each have a 3rd ownership in the company. Each was issued 200,000 shares of common stock. It could have been each was issued 2 shares of common stock. It's just they decided to issue 200,000 shares of common stock. They retained a good securities attorney, which is always important, to create the initial organizational documents and to issue the stock certificates. And what's important on that is, if they ever had the idea they're going to raise future funds, make sure you always paper what it is you've done this round and who owns what. We've stepped into situations where we've had a founder, maybe had another co-founder partner, and he said, well, I've always agreed that, X would get 10% of the company. And you find that out while you're out raising other capital, and you got to, kind of pause and go back and make sure all of that previous activity is papered. I don't know if Sheldon, Lana or Tej, you've ever experienced that before, but it's very important in the initial formation of the business that not only do you get an understanding of who owns what, but it's properly papered and documented.
Let me just add, it isn't just the initial. I know in a business that I was part of 10, 12 years ago, the VP of IT had a side deal with actually someone who worked for me, that he would be given part of the company if he stayed so long, but that was never papered. So then as you go to raise additional money or sell the company down the road, that person has their hand out, and again, it was never on the cap table.
Yeah, it's very extremely important that, it's just doing everything right initially makes the future rounds, and even if they never raise capital again, even future disputes and everything else, it's always important to say, here's what we've agreed upon today. Here's the paper, here's the paperwork on it, get it executed. That way everybody understands and they can focus on growing out the business.
Yeah, JD, I would add, I look at many of these documents on behalf of companies entering accelerators also. And there are so many handshake agreements, so many things that the founder or the person signing the document would say, we'll get to it. And it's been hard, but necessary to say, no, we got to get to it now before the check is written, not after the check is written. Getting that cap table right early and then continuously is probably the most important thing.
Yeah, when I step in, a lot of times with early stage businesses, even if they've been through one round, I mean, one of the initial questions I have is, who's your securities attorney? Can I see your operating agreement? Can I see your shareholders agreement? Can I see your cap table? Just to see how kind of, if you will, how prepared they already are. And, a lot of times it's, oh, well, we haven't done the operating agreement. We've been talking about it. And it's just one of those things that's just very, very important on the early stage. It's the foundation to allow you to do everything else you want. So it's just very, very important. So go ahead, Lana.
I was just going to say,
yeah.
I had this experience with Clinic Note in 2016. So initially Clinic Note was founded in 2015, and it was founded by 3 guys. One of them now is my husband, but we ended up doing a recapitalization, and it was very good that we had the cap table all written out. We had all of the documents in place, because it could have been really messy. The initial founders didn't end up getting any equity because they weren't working on the business anymore. And that's an example of a down round or a recap becoming a good thing for me and our investors, at least a little bit, because the company still existed, but we all were initially diluted to, or those initial founders were diluted to nothing. And we kind of started fresh with the cap table. So you kind of might think that recapitalizations aren't the best thing ever, but sometimes they can end up being a good thing.
Lana, I think you bring up an amazing a historical fact. What's even more important than the fact that the recap happened is that the conversation started the day or two before Christmas, and it had to get done by the end of the year. Now imagine not having that legal paperwork clear and complete. I mean, Joe remembers working through it with me, and Lana. Had those documents not been buttoned up as well as they were, what Lana is describing probably wouldn't have happened.
Yeah, I think it was a week before our wedding in November, and we had like the conversation of what are we going to do, and then we got all the paperwork done by the first of the year. It was very quick, and kudos to Joe and you on that. I don't even know how that all happened, because at that point I was kind of along for the ride, and I just was ready to do the work. But I didn't necessarily know all the logistics that needed to happen. So in that case, it's really important that you surround yourself with people who can be very helpful and that do know the things that need to be in place. Otherwise, as a founder, you're kind of on your own in that case. So it's really, really important to surround yourself with people who are smarter than you and can help you and are willing to help you.
That's well said. It's real well said. And we'll get into even a down round and talk through it. But to that point, sometimes it can be a very good thing, because it basically sometimes saves the company, which perhaps in this situation for you, Lana, it did. So and again, having everything documented and having everything organized is just so critical to the process. So simple snapshot here. Amy, Bill, and Chris, we've issued 200,000 shares to each of them. There's 600,000 shares outstanding. Amy has 200,000 of those 600,000. She owns 33.33%. They total 100%. Again, we could have made those shares any number, right? It just was determined. Hey, let's begin in the hundreds of thousands and issue some shares. And this is really what the initial founders cap table looks like. So after they formed, the product development continued for several months. In a typical scenario, they decided they needed more resources to complete development and testing. They also want to create an awareness campaign, start some initial marketing, maybe spend a little bit of money. They decide they need about $250,000, and they want to kind of approach, their family members, some friends, some associates, to help complete the development of the prototype and start the initial market awareness program. So they put together, some initial materials and a presentation and start to meet with some family and friends. Even though they're early stage, they feel that, that their product suite does have significant opportunity. They set a random number of a pre-money valuation of $1 million, which meaning if they bring in $250,000, a post money of $1.25 million. And after multiple meetings and conversation, Amy's uncle Charlie decides to fund the entire amount. So I'm going to spend a little time on this, and really this is all basically just kind of an Excel-driven document, but I'm going to walk you through some scenarios here, and I'm going to try to bring my cursor over. But basically, the number in green is what was a negotiated number, but they didn't have to negotiate with Charlie too much, and they set the price of the business at $1 million. Well, today that $1 million, they have 600,000 shares. So it's as simple as taking $1 million divided by 600,000, and they get a price per share of $1.67. People hang up on price per share a lot of times, but the more important number is the $1 million, because there might only be 60,000 shares outstanding, and that price per share would be obviously proportionally higher. So basically, the 1 million divided into 600,000 creates a price of 1.67, carried over to the 600. Charlie invests $250,000 divided by 1.67 gives Charlie 149,701 shares. So now there's 749,000 shares outstanding. So basically, it's just a math process of saying, you know, that Amy owns 200,000 now of 749,000, or 26.68%. And the same thing with all the other founders. Charlie now has 149, just under 20% of ownership in the company. And they basically have set a post-money valuation of 1.25. That dollar sign right there should not be there. Those are actual shares. That's my bad. But again, all we did is extend this out to an additional round, took the process of saying, okay, 1 million into 600, we set a price. We know how much, you know, that Charlie's going to invest. But what we can do now is run this table right now. The founders could have gone into this document, changed this number, the green number, to 2 million, changed it to 500,000. And it would have run the scenarios to show what their dilution impact was, or what if, you know, we only want 200,000 from Charlie. They could have gone through this whole process and run scenarios of kind of where they are. But the point is, now they've gone from 33.33% to almost 27%, and they've got $250,000 in the bank to bring on additional resources and fund out operations.
Can you explain how the new shares came to be, like where that number came from?
Yeah, and exactly right. When they originally formed, and again, we've had this structured as a C corp. When they originally formed this, they had what was called, you know, basically they have authorized shares outstanding, right? So they don't have them in treasury, but they're just, hey, they can issue so many shares, and it's generally, Joe Leo, if he's on, can maybe add a little more to this, but basically they have issued, and then they have so many shares authorized. So basically, they're not taking shares. Amy, Bill, and Chris are not issuing their shares to Charlie. The corporation is issuing more shares. So basically, the corporation then is expanding and saying, now we have more shares outstanding. And again, Lana, to your question, the 149,000 shares were already basically authorized to be issued by the corporation at some point. You know, they may never be issued. And then they would always be, if they never raise capital, these guys would all own a third of the business going forward. But it is a simple math equation of saying that $250,000 at the predetermined price of $1 million, basically we've set a price of $1.67 a share, and basically 250,000 into the 167 gets 149,701 shares. So, and again, the ability to kind of play with those numbers a little bit and look at the impact on founders. A lot of times founders think, oh, goodness sakes, I'm going to go down to 27%. But another way to look at it is you've got $250,000 now to go build out your business.
And I guess then just to follow on with that, is that number of shares always then determined by the pre-money valuation of the number of shares?
On a new round of financing, it is, Lana, and it's always a negotiated process of what the valuation is going to be set at the financing event. So yes, it is. It's based upon the total number of outstanding shares on the term on a fully dilutive basis, and we'll get into kind of more about what that means. But it's always based upon the valuation set, and that's how it's basically, the vernacular is the same as basically a publicly traded company. The market cap is the total value of the corporation divided, you know, basically divided into the number of shares outstanding is what the publicly traded company trades at. And in a private company, it's very similar. It's just for, you know, again, what we're saying now is the market cap, because Uncle Charlie set a value on the business. The market cap is now $1.25 million. Okay, now let's talk a little about option pools. And option pools can come in, you know, in a latter time event, maybe as the company matures a little bit. They can also come in the process of bringing on new employees, and a lot of times what we call incentive comp. So here they've identified a key hire. After they got Uncle Charlie's money, they identify a key hire that they want to bring on board. You know, unfortunately, they can't pay her a great large salary, but you know, they discover in talking with her that she wants at least some equity upside. So they meet with their attorney and they work to establish what is called an employee option plan for key hires. They decide they're going to allocate approximately 10% of the ownership opportunity. So they're going to carve out an additional 10% shares out there for future opportunities to be issued to employees and have a vesting period to occur. So the key hire joins and what she's granted is options. And because it was just right after Uncle Charlie's round, here's where we are is basically approximately 10% shares. They rounded, but again, there was no financing event here today, but they've issued an additional 85,000 shares or authorized additional 8,000 shares in this option pool. We look at it at a fully dilutive basis. All of these could become owned shares at some point. So on a fully dilutive basis, we look at this. These 85,000 shares are on the cap table now, and we've priced them today at $1.67 because that was the market value at the time the option plan was granted and executed. For this process, we're going to go through the whole process. Like it could be as they go down, you know, they might have issued this key employee 10,000 options, et cetera. Under this scenario, we're going to go down as we're going to assume all these options are priced at $1.67 because what can happen as well, and not to go down too deep of a rabbit hole, next year, there could be some options that haven't within this pool that get issued as well, but they might be repriced at the current valuation of the company. For this scenario, we're going to price all of these at $1.67 and assume the vast majority were basically issued to employees during this period. I don't, you know, again, I don't want to gloss over it too quickly, but again, it's just a carve out. It is a dilutive impact, but it's basically allowing the company to basically use some incentives of their stock to bring on key hires without having to, you know, maybe pay and erode some cash flow of the business. Trying to see if we had any questions. I don't know if the chat room,
There was one, JD, and I've answered it regarding the art of valuation.
Okay, thank you very much. So I'm going to run through the seed round. Again, they've now got obviously Uncle Charlie's money. They brought on some key hires. You know, in the normal evolution, and you know, Lana, Tej, and Sheldon are all entrepreneurs. They've all started businesses as well. They can kind of, you know, not everything goes at the timeline you want. So basically had some technical issues, you know, why they've made progress, you know, they're running out of money. And, you know, they have a staff of 5 now and they need more resources. They decide to raise a seed round of financing for product completion and working capital. And without getting into the long exhausted process, they present to multiple funds, and Plains Angels agrees to invest $500,000 at a pre-money valuation of $2.5 million. There's belief in what the company's doing. There's belief in the market opportunity. And therefore, they're going to set a post-money valuation of $3 million. I apologize. This is going to start to get a little hard to maybe read. We blew up the seed round and kind of reduced the friends and family and the founders round a little bit. But I'm going to walk through this again because all we're doing is showing kind of an extension off of the formulas that we just talked about. So if you look after the option round and everything, we had 834,701 shares were outstanding. We negotiated with Plains Angels here of a pre-money valuation of $2.5 million. And again, valuation and how you price maybe the exercise of options and all of that. There's a lot of technical issues that can drive value. For this presentation, we're saying that it was negotiated of a $2.5 million pre-money valuation with Plains Angels. That 2.5 million divided into 834,701 gives a rounded price per share of $3. Plains Angels $500,000 here invested at that $3 yields 166,667 shares. And then basically that after the new shares, after those shares are issued, there's a little over 1 million shares outstanding. And Plains Angels then gets a little less than 17%. Our founders now have gone all the way from 33% to just a little bit under 20%. Uncle Charlie went from, approximately 17% to, a little under 15%. And then basically the option pool coming in is diluted as well as we go through, but it's still enough options out there for, key hires to be able to bring on key hires to further incent the existing employees as well. So again, it was just a math equation. We could have played with this number. It could have become $2 million. That would have changed, all of these numbers. Could have been $3 million. We could have decided to only raise $300,000 because we didn't want to further dilute, but we thought we needed that $500,000. But now the founders have brought on $750,000, have an option pool, and still each own just a little bit under 20%. So what I'm going to do here is we'll walk through the Series A, and then we'll take maybe a 10-minute break, and then regroup. Tej, are we going to lose you at some point?
At 9:30, yes, JD.
This work thing gets in the way sometimes, doesn't it, Tej?
I'm so sorry, sir. I'm available to answer questions. I've had one request from somebody in the group already. I'm happy to take questions via email. I'll place my email address in here. If those of you who are entrepreneurs are seeking funding, I would recommend going through the Plains Angels website for that. But if you have a question related to this presentation, I'm happy to take a question via email and try to answer the best I can.
Well, we appreciate your participation, Tej, in this. So what I'll do is I'll run through the Series A, and then maybe we'll take a kind of maybe a 10-minute break, grab some coffee, and then come back. So we've been through the process now. They basically, the beta was, the development was completed. The beta was successful. They've been running for a while. They've through an 18-month period of some starts and stops, they've created an annual recurring revenue stream of about $1 million. They've decided now they need substantial capital to scale out operations, launch nationwide. They are generating some revenue, have a staff of 14 people, and they're continuing to grow. They hired an advisor and launch what they've defined now as a Series A round to raise $2.5 million. So as you can tell now, they're kind of in the big leagues here. They're going to bring some substantial capital on and really scale operations. After 4+ months of pitches and meetings back and forth, they receive a term sheet from VC Ventures. And what that means is obviously VC Ventures the company now hasn't set the value, but VC Ventures did. They were, maybe wanted a higher valuation, et cetera, but they were waiting for basically the institutional investors to come back and say, here's what we're willing to do. 4 months is probably 4+ months is probably even a short term for raising a Series A to some degree. What is agreed to is $2.5 million of preferred stock. They get 10% dividends, non-compounding, and all that means is the non-compounding piece is you're not going to get 10% of the accrued dividends that are due as well. They manage to convince VC Ventures and the marketplace as well that there's great opportunity here, and they set basically a $7.5 million pre-money valuation. VC Ventures does, require what's called a liquidation preference of 1x. That just means they're guaranteed to get their investment out before anybody else, before any common shareholders get any proceeds upon a liquidation event. And then as you'll get into in the term sheet next week, there, some governance restrictions. Maybe it's, company can't borrow money without approval. There's, board governance. There's certain things that the company can't do without this class of stock approving it. And again, you're going to have to squint your eyes a little bit, but it's important to show the whole flow of this. So basically now the 2.5 million that we've already discussed, we have a little over 1 million shares. I'm gonna actually take my glasses off, look at it. We have over, 1 million shares here outstanding after Plains Angels, et cetera, came through. We're going to take the 7.5 million and that's our pre-money, negotiated pre-money. We're on a fully dilutive basis. We're going to divide that by those 1,367 shares to arrive at a price of $7.49 a share. The 2.5 million divided into that 749 basically equates to 333,778 shares, or basically 25% of the company. So now the owners have brought on $3.25 million. They've issued an option pool, and they still collectively each own just under 15% of the business. And now they're ready to scale and go to market. And again, this is what we've kind of walked through here is kind of the normal evolution, kind of in a perfect world, if you will, of, you get friends and family, you get a seed round coming through, and then basically, now you're bringing in institutional money, that you're going to have more governance, you're going to have, some requirements upon you, you're going to have some preferences that they get. They have a little bit of a control position, and we'll get into that when we start to talk about some liquidation scenarios. But, again, pretty general evolution of a cap table. And Sheldon, Tage, Lan, I don't know if you have, anything to recap off of kind of what we walked through. But we can, if you do, great. We can then maybe take a quick break and then, come back and talk a little bit about what happens when things don't necessarily go as planned.
Let me just.
go ahead, Sheldon. Sorry.
Yeah, and maybe we're going to say the same thing. Just for everybody out there, this is, I wouldn't say a perfect world, but it is. And I know we're going to talk about recapitalization if things don't go right down the road. But this does paint a pretty rosy picture, where every round is progressively higher. You're getting just key investors along the way. One thing that can happen early on is, instead of a Plains Angels coming in as one entity, 10 different high net worth people want to be on, and now you've added even, let's say, 10 additional investors compared to one entity. This is a fairly, maybe typical, but I would say actually fairly rosy, but perfect for this illustration of kind of how we progress from friends and family to a Series A.
Yeah, Sheldon, what I was going to add was, regardless of the level of comfort an investor has with a company, this exercise of going through the spreadsheet is something that we do without a doubt, without question. Because without these numbers calculating right in a spreadsheet, a check is hardly ever written. And to Sheldon's point of this being a rosy picture of this timeline, I just looked at a current investment earlier in the week where this type of spreadsheet is printed on 3 sheets of paper at 4-point text. It's that detailed a cap table. There's no glasses left anymore for my 50-year-old plus eyes. It's a magnifying glass or control scroll before I can read my own line. So it is a highly positive picture. But this is an exercise that has to happen. Otherwise, the investment is nothing more than a gamble. It's just rotating the wheels in Vegas.
And JD, I know this is your meeting, but I would encourage everybody during this break to think of one question. Because as we go forward, if you don't have maybe a grasp of this sheet of paper, it may make it even more difficult.
Yeah.
So
that's a good point. And let's take what Sheldon said briefly here and talk about. Let's pick on the seed round here and say this $500,000 investment in those 166,000 shares. At a high level, you might have a cap table that rolls up and just shows basically seed round. you might have additional tab that will have the 20 investors that make up that 166,667 shares. And so, you know, we did paint kind of, hey, the simplest picture, you know, one entity, one party writing you a check. A lot of times what it is, particularly in a seed round, it could be multiple high net worth individuals that basically, you know, with that, you know, comes additional communication challenges, additional reporting challenges to them. We always try when we're raising capital to keep as clean a cap table as we can. And that's why a lot of times when, let's just again talk about the seed round, you set a minimum value that an investor could come in. Maybe it's 50,000, maybe it's 100,000, because you don't want a bunch of, you know, you don't want a bunch of $10,000, $5,000 investors to come in and just have that many more challenges from dealing with investor communications, et cetera. But a lot of times on a cap table, you'll have multiple tabs that show all the shareholders that represent that particular round. Then you'll present more of a rolled up picture like this is of, hey, this round was 500,000, represents this many shares. And also what we see a lot now, and Plains Angels does this, the group I'm involved with, we do this. You'll see maybe an aggregation of many individuals coming in and creating what's called a single purpose LLC to invest. And then it's basically one entity, but their LLC has a bunch of investors that go in and invest in it as well. And that's a really good tool to keep maybe the cap table a little less complex, and then basically really only have the company to, you know, basically one reporting requirement back to that group of investors. Well, if there aren't any questions on this, and again, I mean, we're trying to kind of lay this at a very high level and really more of an introductory level of the capitalization process. We're going to talk next, you know, about a down round, and then we'll walk through some liquidation scenarios. But maybe we can take a break at least till maybe, let's just say 9:30. It's about 9:18 now, and then circle back if that works. I'll leave the screen up. And then from there, obviously, you know, Sheldon, maybe you can help me on the Q&A side after this as questions come in, and Lana as well. And then Lana can add some perspective because we're going to talk about a down round as well. So, all right, I'll get going again. For those joining late, I am not Mike Caldwell. I am JD Genieser, senior partner with LWBJ. Mike had a death in the family, so he was unable to attend today, and obviously the importance of keeping the schedule. We've had Tej was on earlier. We have Sheldon Oringer and Lana Fox on to kind of help moderate me and keep me in line as I go through this process. We've gone through some multiple scenarios of the cap table, talked about some terms and keeping the documents organized. A couple of questions have come up. One of the ones that I did want to address was, what's a convertible note look like on a cap table? And in simplistic terms, let's just say if we were going between kind of the seed round and the Series A, that they needed, you know, under our scenario that we walk through, and if you come in late, I apologize, but basically where it was a company that's gone through kind of a founders round and then a seed round. And, you know, those two rounds resulted in $750,000 of capital raised. If they would have made the determination they weren't quite ready for a Series A, which we showed they did raise $2.5 million on, but they wanted to maybe not yet price that round, but get a bridge financing or get another $500,000 to create market traction to then move into the Series A round. A lot of times corporations, companies will do what's called a convertible note instrument. And, you know, without getting into a lot of specifics, maybe this has been covered in other sections, maybe it'll be covered next week. But really what it is it's basically allowing somebody to invest in today and then convert that note into equity at a discount into a future round. We generally see discounts of 20%, 25%, sometimes less of that price. So in the scenario we walked through before, if we had raised, you know, $500,000 in a convertible note, and then we were going to go raise an additional $2.5 million or whatever, that $500,000 was converted at a discount to that $7.49 price, and basically get more shares issued because, you know, in a sense, they were taking the risk in advance and coming in. Some convertible notes have caps on it, so they make sure the valuation doesn't run away from them. Most convertible notes have interest that's accrued during that time. And generally what happens is that interest is converted as well. And then most convertible notes are triggered conversion by what's called the qualified financing. And in the scenario of the Series A, what they could have said is the qualified financing of $2.5 million, including the convertible note. So they could have brought in an additional $2 million, and then that $500,000 would have converted at a discount, but that would have triggered the conversion of the convertible note. Sheldon, Lana, you maybe want to add a little more perspective if I missed something there.
Here's what I'll say. First of all, just to go backwards, to me, you still list the convertible note or safe note for that matter, on your cap table, but it doesn't have a price. So, I think maybe that's where somebody was coming from, and I'm just absolutely guessing. It does not show a price. Why? Because it's not equity, it's debt until it converts. And then as JD just said, it will convert with a qualified offering, typically at a discount. Let's say it's 20% or whatever the number is. And then it might have a cap, which protects, the buyer of that debt instrument, that it doesn't, like JD said, run away from it. But it does show on the cap table, it's not priced, so it doesn't mess up the shares until it converts to equity at the proper time.
Yeah, and we've even seen, early stage companies that maybe it's their first round, they don't feel comfortable pricing the round, so they come out with a convertible note offering. I'm not going to get into safe notes and all of that. That's really a topic for another day. But it basically allows the company not to necessarily set an equity price today, but then it's basically a trigger for conversion.
JD, Sheldon, I have one quick question, and I just wanted to recap. So, Sheldon, you mentioned something like there was a cap on the note. Was that a valuation cap, you said?
It would be a number cap. So, JD, either way can handle. Let's just say in this example, again, I don't know when it'd be issued. We're making all this up. But there's a $5 million cap. So then, it would have a valuation cap. It wouldn't have to, but any somewhat sophisticated investor would ask for a cap.
Right. Is that something that would be worked into the note when it's being created, or something that happens afterwards?
No, definitely before you sign it. On the investor side, before you sign it.
Yeah.
Yes.
Yeah, and I always, particularly if I'm from the investor side, want to make sure there's a cap. Maybe from the company side, not so much, but all it does is protect that investor. They know they get a discount into the round, but they know they can't get like a runaway valuation. If all of a sudden something significantly happens, they know that their risk associated with, hey, they know at a minimum, they're gonna, the most the company can value is at this, and we get a discount into that. And so it's usually a negotiating tool, and we do see it in most notes. Most investors request a cap, and then obviously interest as well.
So from our end, if we as the company create the note, we would incorporate a valuation cap into the note itself.
Yeah, you don't. It's not always incorporated, right? And it's just and it's not always asked for, but we're certainly seeing it more. And if I'm advising an investor, I would request that cap.
Okay.
Go ahead.
Yeah, I would say that it's almost the tricky part about convertible debt. Sorry to hijack this, is that without actually putting together those pro formas and accounting for them in your cap table, it becomes meaningless how you set that cap. And so I have some spreadsheets that I like to work through with clients so that they understand what they're giving away. And the strategy is the company wants the highest number that they can negotiate on the cap, and the investor wants a lower number. But unfortunately, without actually delving into the math, it's hard to really know what you've given away. And so it's trickier. I tell my clients that frequently, is that that's the primary negotiating piece on a convertible debt or a safe or anything. And the hard part is that without actually knowing how the conversion will work, it's hard for people to get their head around what that number should be.
Yeah, That's a good point. Thank you, Joe.
And let me just throw out I'm not sure if this is from an investor hat or from the entrepreneur hat. The entrepreneur doesn't necessarily want to set a value because he wants it to go up. He believes it's higher in the future, of course. The entrepreneur also wants the investor who writes a check, even if it's a note check, to hopefully add value, whether it's adding value through marketing and sales, whether it's adding value through business past experience, technology, whatever that reason, they're going to add some value, not just money. The investor is saying, wow, I'm going to add a lot of value. I don't want that to run up so high that I've actually caused that increase and then not be compensated for it. So that's the reason for our cap.
I believe there was also a question on options, and maybe Joe, you can help me a little bit on this, but how we generally show, there's basically a creation of an option pool. And in our example, we created 85,000 shares as part of an option pool to be issued to key employees. What we show on a fully dilutive basis is there is that, long-term possibility or even short-term possibility that all of those options are issued to key employees. So on a fully dilutive basis, we always show the option pool. Sometimes you'll see those divided between, basically options issued and then remaining option pool. But the point is, at that point, if I'm investing today in this company, and right after I invest, they basically issue more options to employees. That is a dilutive event to me if the employee ultimately exercises upon a liquidation event. So we're showing that total dilutive possibility to potential shareholders here, that those could all be basically not only issued but exercised. Joe, I don't know if you have any other guidance on that, but that's generally how we show it on a cap table.
It's always one of those things that's sort of that is difficult for people to really think through. And I would tell you that most professional investors, a term in their term sheet is that they're going to want a post-money option pool of some size that they've decided. And some of them will even push for a post-money unissued pool of some size. And all that is that they want the prior rounds and the founders to take the dilution from that option pool. Because if you work through how that, as JD was talking about on the fully diluted basis, by creating a larger option pool before they close on their investment, all of the dilution goes to the prior round. And so those become a kind of a negotiating point that people have. And I hate to harp on it, but you have to, is that without going through the spreadsheet and actually putting the numbers in there, it's really hard to get your head around how much that's actually going to dilute the founders in the prior round. And so, don't ignore those terms on the option pool, because even if they're not issued, like JD said, an investor looks at it as if you're going to issue 100% of those the minute you close on the round. And the only people that it impacts are the prior round holders and the founders when you increase the size of that pool. So sometimes I work with clients and they'll say, hey, I want to, without knowing how it impacts, I want to have a huge option pool because I never know where I'm going to end up. And then you have to kind of walk them through how that can impact their ownership, especially if it's not likely that they're going to use that. So they are tricky, and like I said, it's one of those negotiating points that without actually taking your pencil out and working through the numbers, the impact of it is difficult to conceptualize.
Yeah, that's well said. And for those that don't know, that's Joe Leo, partner at Brown Winnick, and Joe has term sheets next week. So a very valuable session as well. Thanks, Joe. And please chime in throughout. Your input's greatly appreciated. So with that being said, I think I'll move on with regard to, we've completed the Series A. Basically, here's where we are with their, with the current ownership. The option pool still exists. VC Ventures, a venture firm, now has 25% of the company. The founders still just a little under 15%. But obviously they've now brought in, over $3 million of financing. And, the potential looks very strong. They have strong revenues. Now they're really ready to scale and go to the marketplace. Sorry about that. For some reason, it's not letting me go. Okay, we got it. So SaaS systems, initial traction, really didn't lead to a nationwide market acceptance. Many larger companies moved downstream, developed comparable products, and they were able to deploy those much faster with their resources. You know, they were getting squeezed on pricing and margins began to erode. They needed more capital to position the company. The Series A investor was you know, kind of driving how, you know, basically to get their return back. You know, they thought potentially now there was an opportunity to get enough cash flow in, do a little bit more product development, and explore the possibility of an exit of the company. So again, this could be a situation where it's a different entity, but they negotiated with VC Ventures again on the Series A to fund through product suite enhancements, you know, and seeking an exit with an industry competitor. If you remember from our Series A, our post-money valuation, we had set a pre-money of 7.5. VC Ventures put 2.5 in. We had a post-money of 10. Well, now VC Ventures is doubling down and will put in an additional $2 million, but at a $5 million pre-money valuation. So, and basically at the same terms. That's not always the case. And I will walk through a scenario, you know, the what if scenario if it wouldn't have been the case. But basically VC Ventures is, you know, they've got money in it now. They're doubling down and saying, okay, we'll put 2 million in, but we'll set up a valuation of 5 million. So as we look at this, we kind of consolidated some rounds here. Here's where we were on the Series A, right? Everybody basically, you know, VC Ventures had initial 25%. The options have been diluted a little bit more. But now what we've done is we've gone from $7.49 a share to $3.74 a share, because all we're doing is taking here at the end of the Series A, there was 1.3 million shares outstanding. The price was negotiated at a $5 million valuation on a fully dilutive basis. Now all of a sudden it's $3.74 a share. I'm not going to get into the fact that everybody on this cap table probably had rights to co-invest and all of this kind of stuff with VC Ventures. And we can talk a little bit about that in term sheets next week, et cetera. But under this scenario, VC funds it all. And as you can see, this time their $2 million gets 28% of the business. And they dilute themselves a little bit from their Series A, obviously, but their Series A still holds a little under 18%. So now VC Ventures has over 46.5% ownership in the company. And the owners now are at a position where they're just under 11% ownership, but now they've brought in now an additional $2 million of financing to grow out the business. We've seen recaps a lot more punitive. We've seen recaps wash out common. We've seen recaps wash out basically all of the prior investors. You know, this situation, it's at least, you know, still left some ownership for the founders, and basically position the company now to kind of get some fuel in the tank, do some further product enhancements, and continue to go. Now, a lot of times recaps, and Lana can talk a little bit about this, could lead to, you know, just the continued growth of the company, and, you know, it prospers for many years. In this scenario, we're going to be under the assumption that it's basically product enhancements, and we're going to move towards an exit here within the next year to two. But, you know, if that money hadn't come in, even over here, all of our friends here, the founders, had almost 15% of nothing is still nothing, right? So, you know, and that's maybe how even, you know, Charlie and the Plains Angels will look at it as well, is to say, well, we're going to get a little diluted here, but we need this capital to at least be able to get us some return on that investment. I kind of went through that. Go ahead. Yes, please.
I was just going to say, I mean, I don't have a ton to add here. I just think I can't stress enough. I saw a lot of people are doing friends and family rounds. Even if you don't really want to sit down and put everything in the cap table, you have to. And make sure you find a lawyer that has some experience with this, because they can tell you if it looks right and check it over for you and make sure that you're other documentation also matches it to describe, how your company should be outlined. I mean, and they should be able to explain it to you in some layman's terms so that you understand how it works, at least high level. And then, I don't know. I think it'd be interesting working with a lawyer that didn't know what they were doing on this, but I think finding a lawyer that does is really important because it can just take away some of that headache. I don't know if you guys have some experience with that or how people should find lawyers. Like I work with Brown Winnick with Jolio. So he has a lot of experience with seeing a lot of different cap tables. So it put my mind at ease. So.
Yeah. And I'll even say, it's with regard to it, it's also, the lawyers that are used to dealing with emerging startup companies that, want to run nimble, and that, understand kind of that whole process. It's ultimately a lot of times the first or second question I'll ask somebody when I meet with them, who's your counsel? Because it's so important. And that's a great point, Lana, because it's really understanding not only what needs to get done, but how it gets done. And, we do have some situations where some things even get over papered and stuff like that. But for the most part, it is working with a good attorney that can advise, how all of this works.
Yeah, and sometimes you don't know what you don't know. So I wouldn't have known what questions to even ask back in 2015 because it was so brand new. And it's okay if things are brand new sometimes and you don't necessarily have all the answers. But again, finding people that do have a lot of answers and some research and experience, I think is really important.
Just throw out that when you're raising money as an entrepreneur, you have these expectations or pro formas of obviously kind of, going up to the right, and you sell these investors on that same line going up to the right. And what we're talking about is when things probably don't go to the right as fast or as expected as you were when you were raising money. And that doesn't mean just because you missed some numbers, you're going to have a down round. But the expectation is once you've raised money, the situation is bigger than yourself. Now there's a company, and that company is an entity. And in theory, we're all trying to make that company do the best we can, which means in some cases, in many cases, the example that the initial shareholders, the founders, are going to take less equity, but they're still going to have, I can't see it to the right, some pictures of over 30% of the company, which could still be a tremendous payoff, which hopefully will still be a tremendous payoff as the company continues to mature and grow.
Yeah. Yeah, this is probably structured as somewhat of a generous down round, but it is a 50% haircut in value. And so to that point, I mean, it can be sometimes a lot more onerous on, the founders and initial investors with regard to down rounds. And one other thing I will say, and I think kind of Lana was alluding to it too, and we talked a little bit about it. We've seen down rounds happen sometimes, not because the company was in trouble. It was just because, maybe Uncle Charlie's round or the Plains Angels round was just too high a valuation, and so, they're still getting traction. They still need growth capital, but it's like you raise money at a $10 million valuation. What are you doing? I'll come in at a 5 or 6. And so it is also being, very wise about how you structure that pricing early stage, because we've certainly seen situations where companies are getting traction, but still having trouble raising maybe that substantial capital because their market cap or their valuation had already run away early in their capitalization process. Okay, so that being said, here's where we are in the ownership structure of who owns what in the company. And we're moving on now to basically, the company's worked through, they've got some refinements. They've been through, have some growth in some key segments. They're doing well, and they've attracted a buyer, and, good for everyone. It's a $17.5 million purchase price. Under this scenario, we're going to assume all the employee options had been issued, and we're going to assume all of them were priced at that $1.67. So they're all basically, for lack of, they're what we call in the money. You know, the close came approximately a year after the down round and 2 years after the Series A. So if you remember, VC Ventures came in at a 10% dividend. So basically, you know, VC Ventures is going to get 700,000 of dividends before anybody else gets any proceeds back. But it's still a very good purchase price. So let's do a waterfall analysis of that. And again, I apologize that it's a little small, but if you look at face value over here, this is what everybody owns of the company, right? And this is what we think everybody's going to get back from that 17.5 million. Well, it's just a little bit different, but it's still a great purchase price. One, first, everybody's going to, those 85,000 options. And again, what an option is, it's a right to purchase the stock at that predetermined value in the future. And so that price was $1.67. So those 85,000 options are going to get exercised. And so the proceeds of those 85,000 options at $1.67 is $141,950. So the proceeds available for distribution are $17,641,000. And we'll assume no closing costs, no legal. I mean, again, this is just at a very high level after everything and maybe all other costs had been taken care of. Well, VC Ventures is going to get their preferred dividends, and then they're just going to share pro-rately with everybody else off after the distribution, after the dividends are paid. So VC Ventures is going to get a total off of this of the 17 of about 49%. You know, that's pretty fair. They own 46.5%. You know, their total down here is 48.57, and you know everybody does pretty well. Even the key employees, they got 770,000 and really only wrote a check for $141,000. And all our founders did pretty well as well. So that down round, you know, led to a pretty good event for everybody. And again, prior to that down round, you know, a lot of times you see companies that will resist a down round, shareholders that will resist a down round. But under this scenario, it was obviously to the benefit of all to have that additional $2 million to grow the business out and to seek this ultimate exit. Okay, scenario 2. They didn't quite materialize as expected with regard to the product development. They did see some opportunities and had an opportunity with they were doing some vertical opportunity to sell, and they did receive an offer of $8 million for the company. Well, under that scenario, again, not going through all the math, the employee options were still in the money. And the close came approximately, again, a year after the down round and 2 years after the A, again, resulting in the accrued dividends of $700,000. But this time, that term kicked in a little bit, the liquidation preference of VC Ventures. And all that is they have the right to get their money out first before the rest of the shareholders. And it's either their investment or the value of their shares they own. So again, we're going to walk through this. This time it's an $8 million sale. The options do get exercised, but as you can see, they're going to pay $141,000 here, and they're going to get $249,000 back. So it's still, their options are in the money. But this time, VC Ventures are going to get the preferred dividend, but their liquidation preference is going to kick in. They put, if you remember, $2.5 million in on the Series A, $2 million in the down round, so they have $4.5 million in. Well, the value of their stock in this scenario is only $3.7 million. So their liquidation preference is kicking in, and they're getting their invested capital back plus accrued dividends. So in this scenario, VC Ventures is going to get almost 64% of the proceeds while only owning 46.5% of the company. Again, still, you know, not necessarily a terrible exit for our founders. You know, Charlie did pretty good. Plains Angels, if you remember, put $500,000 in, and they're getting $489,000 back. Again, the down round could have proved successful if the fact would have been that the company was going to die prior to the down round. But you see what is just a 1x liquidation preference kicking in, meaning they get their invested capital back, or they share basically in the valuation. This time the valuation of their stock was below their invested capital, so they got their invested capital back ahead of the shareholders. So let's go through another what if, and kind of walk through some things. And again, you could go down so many rabbit holes and so many worse scenarios, but let's just go through the same scenario as number 2 of an $8 million deal. But what if VC Ventures on the A and the down round were just a little bit different? What if the terms were not a preferred stock with a 1x liquidation, but what if they were participating preferred stock with a 1x liquidation? Just again, and again, Joe's going to cover the term sheet, but terms matter. And what a participating preferred means is they get their money back, but then they also participate pro ratally with all the other shareholders on the remaining capital to be distributed. So again, under this scenario, we have $8 million, but this time because of the liquidation preferences and the participating preferred, the key employees are out of the money. So they're not going to execute the options. And VC Ventures is still getting their $700,000. This time they're getting their liquidation preference back of the 4.5. So they got a total of 5.2, but they also participate after that pro ratally in their ownership percentage of the rest of the proceeds. So VC Ventures under this scenario, and again, there's multiple scenarios and multiple complexities of preferences, but under this simple scenario of a participating preferred and at an $8 million valuation, VC Ventures is getting almost 83% of the proceeds of the sale because their terms were a liquidation preference and it was a participating preferred. So again, the point being on this is, and we'll cover it here, is, you got to keep the cap table current and have all your supporting legal documentation, but the cap table, shows a summary of ownership and doesn't always show basically liquidation rights and percentages of payouts. And it's very important to understand the terms that each round dictates and how that impacts a waterfall analysis upon a liquidation. So it's very important to understand all your terms when bringing on new investors, and always obviously work through that and always keep the ability to run scenarios. And if you don't have a current cap table to understand that, or if you don't have good advisors when you're negotiating terms, sometimes shock can kick in when an event occurs upon liquidation. Those were quick. I don't know if people have questions. That's about the extent of what I wanted to walk through at a high level. There are available resources for all these seminars at that link below. And I think further, we can get that out into the chat room as well, that link. If Lana or Sheldon can help me do that, we'll get that link out for basically all the resources. We did cover, quite a bit. I don't know if anybody has additional questions, Lana or Sheldon, that are out there. We're certainly available. We're all very easy to contact if you have questions. I think in summation, again, this was really kind of a high level basic scenario of a company going through the process and being able to understand their dilution and the impacts of and investor types, et cetera. Each company and each scenario has its own kind of unique circumstances.
JD, as we wait for questions, I don't see any at the moment. I'll just throw out, as an entrepreneur, you may have gotten concerned about the liquidated preferences and the preferences that the financial investor got as they probably recapped the company. They got potentially during the Series A or during the recap. And it's all negotiable. It's all, negotiable. There's some things, the financial investor may say is mandatory by the way that they've raised the funds from their investors. And then other things could be just negotiable based upon the risk that they think that your company holds for them in their portfolio. So I do want you to realize that much of that is negotiable, but with some entities, it's more or less negotiable. It obviously goes without saying that the more money you take early on, the more dilutive it is compared to waiting to take money further in the process. Sometimes people say, I can get $2 million early. If you can't spend it, it's going to be a lower valuation early in theory than it would be down the road some. But it doesn't mean you don't want to have money so you can run your business. It just means sometimes taking it in chunks is better from a dilution it's almost always better from a dilution standpoint. And, you know, I have no, even though I do use LWBJ and I do use Brown Winnick, I can say I'm not getting paid by anyone to say this. I absolutely believe in what Joe Leo and his partners can do for you as entrepreneurs at Brown Winnick, and same with JD and his partners. Feel very strongly that the right financial team, financial people to help you raise or advise you along the way, as well as legal, goes without question is two things you should have check marks on. Because, you know, some people come to me, Sheldon, can you help me raise money? I can't. I'm not a registered investment advisor. You know, you can do things as a consultant, but you can't do things to help people raise money. You need to have, you know, outside professionals help you. So, and make sure you stay legal, because that'd be the worst thing you could do is get in trouble down the road by possibly not having the right entities help you do those things.
And JD, Sheldon, and Joe, you guys have seen a lot of different investments, tons of them. What advice would you guys give to people who are doing this? I saw a lot of friends and family rounds in the chat. So what is some advice that you would give to people doing that initial friends and family round so that they protect themselves for the future and also protect their friends and family? Or is that too general of a question?
No, I'll take it first, and we probably covered, you know, quite a bit of it, and we'll be a little repetitive here, but a lot of it does, you know, probably what we haven't necessarily talked a lot about is even friends and family. You know, it's getting an investor, particularly friends and family, is a whole different relationship and a whole different accountability. So it's one, making sure that relationship can kind of withstand and withhold some of the challenges early stage companies have, and making sure that whoever that friend and family is, particularly because I'm viewing a friend and family as really, you know, for lack of a better term, an unsophisticated investor, a trusting investor, and really, you know, investing based upon a relationship. We've seen, you know, relationships tarnish because money put into a startup company that maybe the friend and or family member could not afford to lose. So it still is making sure, and this is more of a general statement now, whoever you bring on as an investor, it's a different type, it's a whole new relationship, and making sure that you look at it from a perspective of, can I get along with this individual? Can I communicate with this individual? And do I want this individual as a partner? We didn't talk a whole lot about it, but it's just extremely important, even at the institutional round, making sure that you're very comfortable who is on your cap table and ultimately who's going to maybe even bring more governance to you. The other piece is, again, you know, disclosure, making sure that you've got everything buttoned up. You know, I meet with so many people that, like, you know, Sheldon said, they come in and say, I need $2 million to go start this business. Well, why do you need $2 million? Well, because I need $2 million. I got to do this, this, and this. Well, let's model out. Let's talk about, I mean, capital resources, product development. What do you need? Well, it looks like, you know, we go through a whole process with them. Well, it looks like you need about $250,000 to get things going. Why go raise $2 million or whatever too? So it is spending that, even on a friends and family round, it's spending that diligence time as the founder of a company to really understand your financials, really understand the use of funds, really understand how much capital you need. Because, you know, I think Sheldon made the point, if you can raise a little less capital or get the right amount of capital and go get market traction, that next round's going to be able to be a step up at a lot higher value. You're not going to give away as much company as well. So I think pricing is important. I think, you know, it's very, very important, you know, even if a friends and family, that, you know, that you it's a professional relationship, and you treat it as such, and you have accountability as if it was somebody other than a friends and family.
Another comment, JD. This is sort of probably post friends and family. Obviously, prior to friends and family, you're legaled up, right? You have a lawyer that has the documentation, proper entity, and all that. But now you have some money. You're starting out. It's not. I think it's a good thought to have one or two or three advisors. Maybe not ready for a full board yet, but call it an advisory board. You may be giving them some spiff or two. I'm not here to negotiate what that is, but it's obviously things that you're not. If you're a tech guy, it could be sales and marketing and finance help. If you're a sales and marketing type, it might be obviously tech and still finance. You know, just whatever you're not. you want to get some advice, do you have your own, I'm called a kitchen cabinet or advisory board to help you go down this path? There's very few entrepreneurs with whatever background you bring and expertise you bring has all the different legs. Nobody really has all the legs of the stool that they bring, especially early on. And Lana, maybe, I don't know if you want to talk about that or anybody, but you did a lot little to start out.
I would say something that helped us at Clinic Note is by having those key. So I had angel investors, and we would not have survived as a company if I didn't have great angel investors that not only cared about the business, but cared about me as a person. Obviously, they want to make back their money, but I was pretty new out of school. So I graduated college in 2014, and then 2016 is when we had that recapitalization. And initially, I came into Clinic Note as an unpaid girlfriend working because I just believed in the company. And then, luckily, the investors believed in me as a worker, but also in the idea of the company. And our investors, we have some sales and marketing. We have more of that technical, and then more of like kind of the operational. So while I didn't have a ton of extra experience under my belt, I leaned on them heavily, sometimes weekly meetings, sometimes monthly, and that was very key for me. So while friends and family, it can be nice to get the money in the door. Make sure that you find some strategic people to really lean on, because without them, being a founder can be really lonely. And so it's nice to have some people that know what you're going through and really understand the numbers and aren't just giving you free advice that could apply, but isn't necessarily great advice sometimes. And I think for that kind of relationship, it has to be not just like a high level 1 hour conversation one day. It's more of that relationship that you're building over time and you enjoy working together. So.
Great. I want to throw out one thing that I will tell you is a piece of advice that I try to give people. Sorry to keep hijacking, but I will tell you that setting expectations and having investors who have the correct expectations on what your company is and what you're doing is imperative. And I'll tell you, and that starts at your friends and family round, and it goes all the way through. Is most of the time when I have companies that I've represented where they've had problems with investors, it's because there's let me qualify that, where it's not the company's fault, where it's the investors, quote unquote fault. It's not that that anybody did necessarily something wrong. It's that the investor didn't have the right expectation of what investing in a private, illiquid company really means. And, with friends and family, I think that's actually, you run a greater risk. They're used to investing in things like mutual funds, their 401k, where if they get irritated, they don't like the direction of the company, they feel like they're not, as involved in the company as they want, they can just go out and sell it, at a moment's notice. And those investors get to be very difficult and dangerous for early stage companies, because that's not how investing in these kind of companies works. And so I've always found that sort of a disconnect between an investor's expectation and what the company is really offering as far as an investment is the biggest difficulty that you'll run into with investors, where it's just, you can't get along because of that. And so I would be very careful, even at a friends and family level, of taking investments from investors who don't really appreciate the fact that they're in it for the long haul for most of these companies. And it's a different type of investment than what they're maybe used to in other areas.
That's good advice, Joe. We've seen relationships tarnish, as we've said, and a little bit of it is just exactly that, maybe the unknown from the investor perspective of what they're truly getting themselves into. It's funny because I've actually received phone calls from investors that say, I want to get my money back. I'd like to sell, and you just can't, that's not how this works. And so it is. And I think even, touching off of that too, is what we often tell investors again is, you want an investor that brings a lot more than just capital. You want, like Lana was talking about, you want mentors. You want people that'll maybe engage, maybe people that'll help you make key decisions. You want people kind of, that can help you maybe navigate distribution or help you work through sales contracts or bring technology advice to you, et cetera. And so, while you're going through that process, and there's, it's a pain in the butt to raise money. And so, but picking the right investors, whether it be friends and family, seed rounds, et cetera, it's a whole different type of relationship. It's very important that both sides are, understand what expectations are of each other. I don't know if we have any other questions. Certainly, if anybody wants to turn their video on and ask questions, we're certainly here to address those. We do have, again, I think same time next week, the term sheet, which, we kind of touched on a lot of this throughout it, but I think it's a very, very valuable session as well. And I look forward to it as well with actually Joe and Mike. And if there are no more questions, we'll sign off, but we'll certainly give anybody the opportunity to ask any additional.
Hey, Joey, I think I see you're talking, but and you're not on mute. I don't know. I can't hear you though.
You talking about me, Lana?
No.
Joe.
Joey Beach.
Oh, okay.
It looks like she's talking, but I guess you'll have to type it in the chat and we'll do our best to answer.
JD, everyone
Yes.
else, I have a quick question, and this is sort of general, and sorry if it sounds like a dumb question, but so with a convertible note, have you ever come across a situation where an investor buys into a convertible note and then decides they want to call in the note rather than switch to equity? Or does that ever happen?
I've had situations where the term of the note expires before the qualified financing occurs. And Joe can talk a little bit more because he drafts a lot of these, but where it's really, usually there is a period where they don't have that option. As long as you do a qualified financing, they have to convert because that's the document they've executed. There generally is, if a qualified financing doesn't occur in a period of time, then the funds can actually be called by the investor or have that option to convert. I don't know, Joe, if you have any comments on that.
That's typically how they're structured, is that for a period of time, if you have that qualified financing, they automatically convert. It doesn't give the investor the option. And the difficulty, as JD has pointed out, is that if you hit that maturity date, that's usually a negotiating point of what happens at that point. And founder-friendly options, which are you just convert at the cap, which a lot of smarter investors won't say yes to. And the other one is that they can call the note. Now, the problem is that when I've represented investors, I usually work with the company side, but it's the idea that most of the time, your options at that point are not very good, and so you're automatically sort of renegotiating with the company because it's they just don't have the funds to pay you for most of those. So yeah, if it's well written, they should lock those investors in, because the idea is you're not really borrowing money. All what you're giving to the investor, we can talk more about in the term sheet, is that a little higher preference if the company liquidates, because debts get paid first before equity. And you're also giving them the ability to kind of kick the can down the road on the valuation, which both sides might be interested in. Sure. But the intent really is not to pay it back, and if it's structured correctly, that doesn't happen.
Wonderful. Thank you for that.
Good question.
And I know we have a couple questions on the slides and that link. And JD, I wasn't sure what to put for the link when you asked me to put a link in.
There is a link, Lana, that I will get you from that last slide, and all that is it's all of the resources of the series. So gotcha. I will get that up and get that in the chat room.
Okay. What other questions does everyone have? I mean, you general questions or thoughts from the presentation today? Just has it helped you guys in figuring out what you need to do? Giving you a little bit of next steps, or just curious to kind of hear where everyone's at.
I do think a lot of this is a really good lead into the term sheet discussions next week as well. And, you know, how the negotiations of a term sheet and understanding the term sheet is just so important.
Yeah, thanks everybody.
Thank you. Yeah, thank you all for participating. Again, we did a very high level overview, but hopefully you were able to get kind of a little bit education and a little bit of general understanding of the process. Any other questions, please don't hesitate to contact any of us. And like I say, same time next week for Joe and the term sheet.